everybody. Welcome to this week's edition of the Mortgage Report. I'm your host, Mark Panazon, mortgage broker here in Edmonton for Dominion Lending Centers Brokers for Life. This week's featured topic is going to be around debt consolidation and refinancing your mortgage. I've laid out a scenario where this is sort of typical in our market here in terms of the amount of debt and mortgage size that our folks have. So I wanted to lay out some scenarios to show you the benefits of refinancing your mortgage. Okay, so first up, let's take the example of a home worth about $400,000. In Canada, the maximum you can refinance your home is up to 80% loan to value under normal guidelines. So that would be a maximum loan of $320,000. So this is the first step in refinancing your mortgage, is determining how much equity you have. If you are a first-time home buyer and put 5% down your mortgage, it's very unlikely that you're going to be able to refinance that mortgage for many years until you build up at least 20% equity or more. So that's the first thing. Now let's fast forward a few years. Let's say you've been in your home, you've accumulated some debt, maybe your kids' schools, maybe some home renovations on credit cards, maybe you bought a car, whatever the case is, and let's say your mortgage balance is now $250,000. Okay, so if your mortgage is $250,000 and the value is still $400,000, the calculation to determine equity would determine that you have about $70,000 available in equity. So now that you have determined you have equity, let's put together an example of what a debt consolidation would look like for someone who perhaps has accumulated some debt. So the example I'm going to put up here is someone who has $50,000 in debt. Like I said, this is not untypical for somebody in Edmonton or Alberta right now, given the current market conditions. So let's say of that $50,000, $25,000 is a car loan, and the other $25,000 is in various credit cards, 3 or 4 credit cards, let's say up to $25,000 total. Now I'm going to throw some numbers at you, so hopefully you can stay with me on this. So let's break down the interest cost for each item, and then we're going to compare that to what it would cost if you refinanced it into your mortgage. So let's say the $25,000 in credit cards is at an annual interest rate of 20%, pretty typical for credit cards. That's $5,000 a year in interest if you don't pay down that $25,000 of debt. So if we do that over a 5-year term, because I'm going to compare a 5-year fixed mortgage, that's $25,000 of interest you would pay the bank or Visa simply for just carrying debt that you're not paying down. Now, if you're someone who thinks you can pay down the debt, then obviously this may not apply to you, or you may not want to refinance it. But perhaps if money's tight, or you just want to get that burden off your plate and not worry about it, then this would certainly apply. Now let's take the car loan. Let's say the car loan of $25,000 is at 5%, and it's over a 5-year loan. So you're going to pay about $1,200 a year for a total of $6,250 over a 5-year period. So if we go ahead and take that same $50,000 and refinance it into the mortgage, and let's say the interest rate's 3%, which is about right for a refinance rate, that's a total interest cost of $7,500 over 5 years. So if we compare what you would pay in total between your credit cards and the car loan over a 5-year period versus what you'd pay by refinancing, you'd save a ton of money. You'd save about $23,000 in interest over a 5-year period of time. Now, it's very important that I say that that is assuming that the credit cards aren't paid down over that 5-year period of time. So if you're slowly chunking it down, obviously that interest cost will come down significantly, but $23,000 over 5 years, you'd have to pay it down quite a bit to see some real savings there, make it worth your time to not refinance. So the next step would be to go ahead and confirm what your payment would be. So on the first mortgage, let's go ahead and assume that you had an interest rate of 3.25% and about 20 years left on the amortization. So if we leave the amortization alone at 20 years and the new rate is at 3%, so you save about 0.25% on the interest, your new payment would be about $246 more per month than your existing payment. So again, the old payment on your mortgage was $1,415. The new payment would be $1,661 per month. So that is a $246 increase in your mortgage payment. And you're probably saying, hey, Mark, well, I don't want to pay more on my mortgage. But remember, we just paid off $25,000 in credit cards and your $25,000 car loan. Meanwhile, your minimum payment on that credit card, or those accumulated credit cards, was about $500 a month, since most banks take about a 2% payment on the balance. And your car payment would have been around $470 a month. So with your car payment and your minimum payments on those credit cards, you were dishing out around $971 per month. And since you've only added $246 to the mortgage, you're actually saving $725 in cash flow each month, and you're not extending your mortgage any longer. A lot of people ask me or tell me or have the opinion that, well, I don't want to refinance my mortgage, I don't want to stretch out my mortgage. Well, you're not. You don't have to extend your mortgage. You're still in the same plan. You're still going to be paid off in 20 years. But if you got a ton of debt and you got equity, this is such a great solution, because you can save about $700 out of pocket each month, and more importantly, save like $23,000 in interest over that 5-year period. And your payment only goes up $250. But again, you're saving a net of $725 a month. So this is, to me, a pretty clear-cut example of when a refinance is at its best. Now, will all situations look like this? No, obviously. Folks may not have that much equity available. Perhaps there's not that much debt that we're actually refinancing. But I wanted to show you an example that doesn't seem that outstretched for some folks, given the amount of debt that Canadians currently have. So if you think that you might be in a similar situation, and you're just curious to know what your equity position is, or what some of the interest costs are on some of the debts you're carrying, reach out to me and I'd be happy to calculate this stuff for you and figure out if it makes sense to do a refinance. Now, one last point in this video, and that is regarding mortgage penalties. So I didn't include anything in the slide in regards to how much it might cost to refinance. There are certainly other fees involved, such as legal fees, maybe appraisal fees. There may even be mortgage penalties if we're switching lenders, things like that. But if you think about the total savings we talked about, $23,000, even if it costs you a couple grand in penalties and fees, I mean, you could still see the value in refinancing your mortgage and getting you debt-free sooner. So, hope this all makes sense. I hope you guys can use this in your own situation. Or again, if you have questions, feel free to reach out. Have a great day, everyone, and we'll see you next week.